Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called Rocket Lab, and the title of this slide says Rocket Lab stock is falling, and that's a good thing. What we've noticed recently is that quite a few pundits seem to associate the price of a stock with the quality of a company, which are two distinctly different things. If you have a quality company and the price of the stock goes down, that's a good thing because we always want to buy assets cheaper and hold them for the long term. So Rocket Lab stock has corrected significantly over the past, let's say, 6 months or so since we last covered it. So the last piece we wrote was why we're avoiding Rocket Lab stock. And there were several reasons why we had the stock listed as an avoid. The first being that it was very overvalued. And the second was that there wasn't enough information to make an informed investment decision. And you can see on the chart here, the blue arrow points to the last time we wrote about the stock. And since then, it's fallen 50%. While revenues have increased. And that does wonders for our simple valuation ratio, which means this stock is now what we would consider not excessively overvalued. When we look at 2021 revenues, the company filed a 10K. We're able to peruse that for insights. There's a great deal of rich information in there, starting with what they actually managed to accomplish in 2021. The glossy SPAC deck said we were to expect 69 million. The company brought in 62.2 million, so a shortfall of about 10%. We could start by looking at the launch cadence and profitability for the launch systems revenue segment. So in 2020, the firm built 8 rockets, same for 2021, and they launched 7 in 2020 and just 6 in 2021 because, of course, the Rona, which is the excuse that constantly keeps on giving. So one metric we found particularly useful is the profitability of launches, and they provided us with revenue per launch and cost per launch for both years. Now, when we look at cost going up between 2020 and 2021, that is, of course, has to do with some COVID problems and some other manufacturing issues that they would anticipate as being temporary. So if that cost per launch stayed the same, they would have had profitable launches in 2021. Now, what will really drive down the profitability of launches is if they go towards reusability. And here you can see the charismatic leader of Rocket Lab about to eat his own hat. This is a man who does what he says he's going to do. And he said that if they ever move towards reusing rockets, he'd eat his own hat. So in a video on YouTube, you can see him pop a piece of that hat in the blender and give it a go. And what they plan to do this month is they're going to catch a falling booster using a helicopter. They've been doing tests, and now they're actually going to do that with a live mission. We could see that as early as next week, sometime this month probably. They'll be trying to catch a falling booster with a helicopter and moving towards that reusability, which is a great thing for the cost of launches to bring that down. Now, when we look at the other revenue segment, space systems, that's largely gone up because the company made several acquisitions in 2021. Advanced Solutions, an engineering company that develops software, simulation systems, guidance, control systems, and whatnot, and Planetary Systems Corporation, which develops this lightweight hardware that streamlines the process of attaching spacecraft to rockets and releasing them. And this third acquisition just closed last quarter. So we're actually already in Q2 2022. So this closed in Q1 2022. And it's a company that builds radiation hard solar cells. And this was at a cost of $80 million. So we will see that company almost a full quarter of their revenues realized in the first quarter of this year. One of the things that Rocket Lab provided us that's particularly useful is this pro forma look at what their financials would look like if they acquired the 2 companies that they did on January of 2020. And that gives us an idea of how these companies are profitable, so they would have helped reduce losses. And it also shows us that they're quite impactful from a revenue standpoint. This will help provide more consistency quarter over quarter, making our simple valuation ratio more effective over time. And what we can look for next is Q1 2022 results, which the firm is expecting to come in at lower range of their guidance, 42 million. They expect about $14 million coming from launch systems, so perhaps 2 launches in Q1. And then they're anticipating the space system segment to have revenue of at least $28 million, and that should have nearly a full quarter contribution from SolAero, their third acquisition. So we'll be expecting that revenue to come out fairly shortly. In terms of full year guidance, they made some comments. One was that they expect to realize 60% of their 241.5 million backlog in the next 12 months. So that's about 145 million. But in that same deck, they also talked about how backlog had jumped to 545 million, almost doubling in the few months that following the end of 2021. And just need to remember that when we talk about backlog with any firm, we don't give a lot of credibility to that. They operate on fixed price contracts that could be terminated at any time. So that's a lot different from the predictability of a SaaS business model. So there's really 2 revenue metrics for investors to watch: the $176 million in 2022 revenues they promised in their SPAC deck, and of course the Q1 2022 guidance of 42. That's on the lower end, $42 million. Now, when we look at customers for Rocket Lab, one thing we noted was that the US government was a 25% of revenues customer in 2020, and that slipped to 8% this year, which is great. The US government, as a key customer, has all the cards at the negotiation table, something Palantir investors have been finding out the hard way. Now, when we look at customer concentration risk outside of the government for 2021, we see 2 customers accounting for 56% of revenues. That's very significant. If one of those customers goes away, revenues will be impacted sharply. And top 5 customers account for around 70% of revenue. So these acquisitions should really help with that. It's great to see that the revenues are being diversified away from launches and also away from, hopefully, this customer concentration risk. Now, when we look at valuation for Rocket Lab, that's fallen dramatically. It was in the triple digits last time we looked. And if we use the Q1 2022 guidance of 42 million, we annualize that, we get a simple valuation ratio of 22. That's lower, but it's still high when we compare it to other space SPACs that have revenues like Planet, Spire, and Black Sky. These are companies that also have business models that are more predictable, at least Planet does. So the company is more fairly valued now, but also is still a bit rich. When we look at the overall space investing thesis, it's particularly risky. You're shooting canisters of fuel into space with expensive hardware attached to them. So generally speaking, it's a very risky thesis. We don't feel like taking on additional risk in 2022, so we're going to be very careful about any new positions that we move into. We don't feel as if the market is expressing a lot of fear right now based on the VIX. So you can see the chart at the bottom here, that spike in the middle, that's when the market reacted to the coronavirus. And that was the only time they reacted, and it went just to the moon since then. So in terms of what we're seeing now with tech stocks, quote unquote, correcting, if you take a look at the 10-year chart of the NASDAQ, it really is a blip. So we're proceeding very cautiously this year. We are moving Rocket Lab from an avoid to a like, not because the valuation has fallen specifically, but because we now have enough information to gauge the health of this business. They're doing what they said they're going to do. They're diversifying away from launch. They may potentially be able to reduce the cost of launch significantly by moving towards reusability. So we are moving that in our catalog from an avoid to a like. It may find its way into our tech report. As for whether or not we'll invest in the firm, that's something that Nanalyze Premium subscribers are privy to. So thank you very much for taking the time to watch this video. Please put your comments in the comment section. We'll address them there. And make sure you subscribe to our channels. We'll be putting out more videos in the future. Thank you very much.